We're picking up Chapter 9 with the employer reporting requirements at the end of the year. So end of the year rolls around, last paycheck is issued to employees, the new year starts, and as much as you would like to start the new year off fresh, you still have some obligations left to close out things from the prior year, and one of those is issuing W-2s to your employees. This used to be a pretty laborious process, but if you are using an automated accounting software package or you have a payroll company, this is a really, really efficient thing that is now possible. It shouldn't be laborious, and you should be able to get these W-2s out to your people pretty quickly. They are due by January 31st, but why wait? And the IRS will generally start accepting tax returns early in, before the January 31st deadline. So why not get those to your employees? Check this one thing off your list, get those W-2s out, and that way when the IRS starts, being able to process returns, probably the third week of January, your employees have those W-2s, they're ready to file and get their refunds, and they will be happy. Now, once you have prepared all of these W-2s, they have to get remitted to the Social Security Administration, and there is a transmittal sheet. It's kind of a cover sheet that has the cumulative totals of all of the W-2s, and that's Form W-3. And that will go with all of the W-2s to the Social Security Administration. If you are in the kind of industry that provides gambling or winnings to patrons, you will also have to file a Form WG. And again, this is for gambling, lottery, any sort of winnings. That also goes no later than January 31st. And those go with Form 1096, which is due by March 31st. If filed electronically, it should say. You also, as a business person, may have 1099 obligations. If you had vendors that weren't corporations, if you had independent contractors, anybody like that, you need to supply them with 1099s by January 31st. Again, if you are keeping really good books and records all along, this is a pretty easy thing to accomplish. There's plenty of software out there. I actually I only have really a small handful of 1099s that I ever have to issue in any one year. It's not worth it for me to pay a service to do it. And so there is an inexpensive, and I won't say the name because I don't want to promote any particular service here, but I pay $3.99 per 1099, and I fill the 1099 out online. The company sends the independent contractor their copy of the 1099 and takes care of filing it with the federal and state government, and I don't even have to touch it. I get the filed copies back for my records, and for $3.99, it is a bargain, let me tell you. The other annual reporting obligation for an employer is what's called the 940 return, which is for FUTA, federal unemployment. Most unemployment is collected through the states. So you have been, as an employer, remitting your quarterly unemployment returns, and maybe even on a monthly basis, depending on how much you have to file. You've been paying your unemployment to the state, but there is a federal component to that as well. That is a return that gets filed once a year, again by January 31st, and it is 6% of an employee's wages up to $7,000. Because it's just me here, and if you do the quick math, 6% of wages up to $7,000 comes out to $42 a year. I don't bother to make deposits for this. You don't have to make deposits unless you reach a point where you've got enough employees that you're going to exceed $500 during the year in FUTA. So I do my 940, they get my 42 bucks. If I had an employee, the most they would be getting was 84 bucks and their return. And I do that while I'm doing W-2s, 1099s, kind of the whole wrap up in January of the prior year. And I think I just said that. We will move into qualified retirement plans. What is a qualified plan? It's a plan that's created by an employer, and it is something which will aid employees in saving for retirement. Gone are the days when most private employers have pensions that are based on years of service, and if you work there for 25 years, you get money for life plus your gold watch. More now, what we're seeing are these employer-sponsored plans where it's based on the contributions that the employee has made. Often there's a match up to a certain amount made by the employer, but this money is generally at risk in some sort of an investment. And depending on your tolerance for risk, it could be in the stock market. If you have chosen safer bonds, it may not grow as fast, but it might still be there when you need it. So these are preferable because it provides certainty for the employer in terms of what their obligation's going to be. They're not worried about how long their retirees are going to live. That's the retiree's problem. If you haven't saved enough money and you outlive your retirement, you should have started saving more or younger. I don't know, but it's still not the employer's obligation. Whereas with the traditional pension systems, the employers do need to worry about how long these people are going to live because that's a guaranteed payment for life. So, as I said, there are these defined contribution plans and defined benefit plans. The defined contribution plan are what you see with your 401ks, your 403bs, your 401as, and these are based on what was put in, potentially with an employer match as well, as opposed to the defined benefit plans, which are based on years of service, and there's a formula for making that contribution. And as I said, these are not very common in private industry any longer. These are most often seen in government type jobs. And you will occasionally read about pension plans that got audited and it discovered that they were underfunded. So in other words, based on the projection of how long the retirees will live, the plan should have X amount of money on hand. If it doesn't, and it can't fully fund those projections, the plan is considered underfunded, and that's a problem, and they've got to go back and figure out how they're going to adequately fund their retirement plans. This happened in New Hampshire not long ago, and the way that they fixed it is you used to be what's called vested in New Hampshire after, I believe it was 5 years. And so what happened, what they ended up doing to fix this is they raised the vesting age. And so in other words, if you left service prior to being vested, you had no pension money at all. You got back anything that you put in, but the employer was completely off the hook. And so that allowed them to kind of rebalance the pension fund. There are also profit sharing plans and employee bonus plans. So there are companies locally that will give quite sizable bonuses, I should say, out either quarterly or annually. And when I'm preparing bankruptcy petitions for somebody, that's something that I have to be particularly cognizant about if they work for one of those employers, because the last thing I want to do is file a bankruptcy and suddenly this person just has come into a whole bunch of money, and a bankruptcy trustee might be real curious about that. So we try and plan around those potential bonuses. Because the money that's going into these pension plans for the most part is probably pre-tax. They limit how much you can put in every year. For 401ks, that is there's an annual cap on what you can contribute. And then for 56,000 is basically in terms of addition to the employee's account, or 25% of compensation. Sorry for the interruption. For folks with a defined benefit plan, there's a cap as well, and that is limited to the lesser of 225,000 annually, or 100% of the employee's average for the highest 3 consecutive years of employment. So now, as often happens, people leave their job. They've been contributing to this retirement plan, and there's a better offer down the road, or maybe they lose the job for some reason. But this employer's fund is holding all of their contributions and whatever employer match that they may be eligible to take with them if they've met the vesting criteria. So how do they get this money out? And there are a couple of ways. Certainly some are better than others. The preferable way would be to go to your new job, say to your new employer, I'm ready to set up my 401k. I got money from an old plan. I want to transfer it over, and it goes directly from administrator to plan administrator, and the money does not pass through your hands. That's the ideal way to do that. And limit to number of times you can do it in a year, and there are no tax ramifications for that. On the other hand, the less favorable way to do this is to have the money come to you. Now, you do have 60 days, if the money comes to you, to turn around and put that money into a new fund without penalty. And so maybe you've left your employer and you don't have a new employer, and so you now need to go open up an IRA. You can still have that money go from old employer into an IRA that you set up through an investment advisor or at your bank or wherever you choose to do that. And that can also pass from administrator to administrator, tax-free. You don't see it. If they give it to you, you again can make that rollover. The problem is that if it goes to you, the plan administrator that disperses it to you is going to withhold 20% of that money for tax purposes. Then when you go to roll that money over, you've got to make up the other 20% that is currently being held by the old administrator to put it into the new fund. So not a great deal. And if you miss that 60-day window, you forget, or you get busy, or there's some sort of a life event that gets in your way, and you miss that 60-day window, you have now just taken a distribution of maybe all of your retirement funds, which could have significant tax consequences. Additionally, if you're under 59 and a half and you were not old enough to actually receive those funds, then you get tagged with a 10% penalty on top of all of it. So unless there are really compelling reasons to go from to have the money come to you before it goes to a fund, it's a much better deal to just have it go from plan A to plan B or IRA B or whatever it is, and not have the money go through you. And that concludes this video on Chapter 9.